Good afternoon. I hope everybody's having a great day today. I think it's 4:15, so we'll get things going. Um, you may notice that Seth Allen looks a little odd there. He unfortunately could not be here in person, so Ryan Shaw is filling in for him, dressed up as Seth Allen. There he is, Ryan Shaw.
Hello, everyone.
Yeah. Seth just had a minor dental procedure and has his mouth is completely swollen or frozen, so he fortunately cannot speak or be with us today. But we have Ryan stepping in for him today, so that's great. I'm sure everybody's familiar with Ryan. And why don't we get started? So, talking about the markets, really this year has been nothing short of astonishing given how strong markets have been. It's really been the Teflon market. Everything that gets thrown at the market seems to bounce off it and doesn't stick, and the market just continues to move to all-time highs. Um, we've started to see a lot of talk about the markets being in a potential bubble. So we'll spend a bit of time talking about that in the presentation, as well as what we think, of the current bull market and how far it has to go. To satisfy our lawyers and compliance department, you guys can give that a read. And key points of the presentation today, as I mentioned, we're off to a very strong start to the year. Well, we're well through the halfway part of the year. Regardless of inflation concerns or bubble concerns or geopolitical events, the market seems to be grinding higher. And so, the clients are obviously asking, like, why is that happening? You're looking at corporate profits remain quite robust. We're still in this early phase of AI productivity gains and investment spending, which is driving a lot of market returns. And now we are getting monetary stimulus from the central bank in the United States and in Canada and other central banks, as well as fiscal stimulus coming in 2026. So the setup for equity markets is pretty solid. We're somewhat in a Goldilocks period. The concerns are obviously valuations, which we'll address through the presentation. But the setup for markets appears to be pretty solid for the foreseeable future. We obviously remain focused on our process and managing risks as we see it. We understand that investing in the market takes risks, so it's really about understanding the risks that we're taking and aligning our views on the market and what kind of risks we're willing to take within equities. And you'll see throughout the presentation as we get to looking at the holdings of the select portfolio, we're not all loaded up on tech stocks or any one particular sector. We're diversified across multiple sectors. And the reason being is when the inevitable turn in tech stocks happens, other parts of the market will pick up. So it's very important for us to remain disciplined. We've been delivering strong returns year to date and experiencing less volatility than the overall market, which, that's really what we strive to do to smooth out the ride for clients. So Ryan, you have a question for me?
All right. The question, like you said there, Jason, are we in a bubble? Seems like there's a lot of chatter on this, whether that's in the news or when we're speaking with clients. I think outside of just an overall stock market bubble, which kind of makes sense, people are asking about that given where we're at in the S&P. There's also talks of an AI bubble, gold, which we've seen lots of strength on this year, and crypto as well. So hoping you can walk us through that and give us your thoughts.
Sure. So are we in a bubble? I think it's important to define a bubble. An asset bubble is a situation where asset prices rise rapidly to a level that's not reflected by the intrinsic value and not justified by the fundamentals like earnings or rents or productivity gains. Asset bubbles typically experience irrational exuberance in the market, lots of speculation, and investor psychology where investors believe markets can go nowhere but up. The fact that people are asking if we're in a bubble would suggest to me that we're not, well, we could be in a bubble, but we're not near the peak of the bubble or the bursting of the bubble. So I think, as throughout this presentation, I want you to just think about like intrinsic value versus um, what is supporting that value. Is there a rational exuberance in the market? Is there speculation in the market? And do investors believe that assets can go only up? I think right now we're possibly in the early phases, but I don't think we're at the point where the bubble is about to burst. So let's look at, past bubbles versus the current bubble. So if you look at valuation, so we're looking here at the NASDAQ and we're looking at the S&P 500 versus the dot-com bubble. And the dot-com bubble the dot-com was primarily tech stocks. So I just focused on the NASDAQ here. If you compare the valuation, so the price to earnings multiple, so where is the index today divided by the earnings of that index? The Nasdaq's trading at about 28 times earnings, the S&P at about 23 times earnings. In the dot-com bubble, we were at about 60 times. That was at the peak. In a bubble, you typically see a big portion of the market cap, this number of stocks, like the largest companies in the market, trading at least 45 times earning. If you look at the Mag 6, because Tesla doesn't have much earnings, they're trading about 30 times earning. So from a valuation standpoint, yes, valuations are expensive, but we're not in nosebleed territory, so we have room to run before things get really frothy. Let's look at earnings growth. The Mag 7 growing at 21% per year, or at least next year. S&P earnings is about 13%. Back in the dot-com bubble, we had about 4% earnings growth. NASDAQ had negative earnings growth. How are we funding all this AI spending? So back in the dot-com bubble, when we were building out all the fiber optic cable, the telecom companies were financing that through debt. Today, most of the financing is coming through cash flow because these hyperscalers have real revenue, real earnings, real cash flow, which you'll see later on. So leverage is not an issue at this point. We are starting to see some debt financing creeping into building out these data centers, but the vast majority of the data center build out is coming from cash flow, which is important. And then looking at the monetary cycle heading into the dot-com bubble, interest rates were rising. We're currently in the point of the cycle where interest rates are going to start to be moving lower. So there's a lot of kind of X's here for are we in a bubble? There's some warning signs, which we'll talk about later on. But I don't think we're anywhere near a peak in the market.
All right, Mag 7 and market valuation. I think this topic is always there. I think it's been a little bit quiet. I think the last time I really heard a lot about the Mag 7 and the valuations there were in 2023. But, valuations increase over time. And Jason, maybe you can walk us through why that happens.
Yeah. So again, comparing the current environment to the dot-com bubble on a earnings basis, at the peak of the market, you're about 25 times. We're currently at, call it 23 times, 22 times earnings. So even if we were to get to 25 times earning on the S&P 500 today, that would suggest about 10% more upside. Okay, so if the market went up 10% more today, we would be at the current valuations back in the dot-com bubble. I can make the argument that valuations could go even higher, for the reason being is there's just not the same number of companies in the market as there were back in the 2000. The number of opportunities has really shrunk, and so there's the same amount of money chasing fewer opportunities. And so, you think about scarcity. If there's a ton of money chasing fewer opportunities, well, what happens? Well, the valuation and the price keeps going up. So, if we're comparing .com to current environment, valuation wise, we could potentially exceed what we saw in the dot-com bubble. Looking at kind of the Mag 7 versus going back to the dot-com, interesting to note that back in the dot-com, there's a few companies that are still around. So Microsoft is still in that list. Oracle, interesting. Oracle's still there. Obviously, IBM's still around. Cisco's still around, but not in the Mag 7. But just comparing the Mag 7 to the top tech companies back in the dot-com bubble, you can see valuation wise, median is about 32 times. Median back then, 51 times. Um, you know, we're just not there yet. Is the point here? And then just looking at the earnings growth for the broader market. So why are markets continue to generate, strong returns? Well, we're expected to have 10% earnings growth this year, 13% in 2026, and 13% in 2027. So, if you look at just the fact, if the market were the price multiple were not to move at all, we should just see about a 10% increase in the market just because of earnings. Obviously, a lot of that earnings is coming from AI and AI spending, but this is one of the reasons why the market's doing so well is because earnings are still very robust.
Beyond the bubble, funding and productivity. So Jason kind of mentioned this already. Seems like if you're on CNBC or whatever news site, looking at stocks, you can see all these tech companies, they keep spending and spending, and the market seems to love it. I think the question that comes to my mind, Jason, is how long can this continue and will it continue?
Well, the spending is quite astonishing. Um, so this is the forecast. This is in billions of dollars of the hyperscalers. By 2027, they're going to be spending approximately $500 billion on data center build out, and you can see that this has been ramping up. How are they financing it? It's mostly been through cash flows from operations. Um, this isn't this isn't like back in the dot-com bubble when telecom companies were laying cable and fiber, and only 10% or 20% of that cable was actually being used. I mean, all that cable is being used today, but it took 20 years for all that cable that was laid back in the early 2000s to actually be useful. It was called dark fiber back then, where it was just sitting idle and wasn't being used. If you look at data center usage, there just simply is not enough capacity today to support the build out. So yeah, it looks like we've got a few years of this spending ahead of us before we reach a point where there's just too much capacity. And then in terms of the productivity gains, you can see since the launch of ChatGPT, these industries have seen really nice ramp up in productivity. There's another chart that also illustrates that further on. Looking through transcripts from some of the S&P 500 companies, we see AI is being adopted. It is being used. It's not just data centers being built for us to make funny pictures or cat videos to post online. Companies are actually deploying artificial intelligence within their business, and it is saving them, or it is finding efficiencies and saving them money. So Western Digital, their recent Investor Day, saying automation and analytics across manufacturing capacity is happening. IBM has taken out $3.5 billion of costs. Approximately 94% of all their transactions on their AI, through their HR department is being used or is being supported by AI, and 6% is going to humans. and similar kind of trends on their help desk. 75% is automated, and 25 um, going to a real human. Dell also taking out about 3.2 billion expenses because of AI, and Cisco. Today over 60% of support cases are touched by AI automation. So this is a real thing. AI within everybody's business. We don't exactly know how AI will be used, and we have a slide on that in a bit, but it is creeping its way into every part of corporate America. Some companies are using it better than others, and they are seeing gains from it. So similar to when the PC was introduced, you saw a nice uptick in productivity. So this is US labor productivity growth. The introduction of a new technology, generally you see an uptick in productivity. So here we are, very early stages of adopting artificial intelligence within our business practices. And you can see what industries are using it the most. Obviously, technology has seen a pretty steep adoption. About 30% of businesses are adopting artificial intelligence within their business, and expected to grow to about 40%. You think about the cell phone and how that has changed since it was introduced since the 1970s. You know, if you were if you go back to the 1970s and you ask yourself, like, I can just use this thing to make phone calls, oh, that's amazing. But did you ever think that we'd be able to watch, an entire movie on your phone? Um, it being an entertainment device, it being able to check on your health and know your heart rate and help you with possibly diabetes. Like, we don't know how this technology is going to change our life. Obviously, there's positives and negatives to the adoption of technology. But if you go back to the 70s or 80s and think about like how you were going to use this simple device just to talk to people, most people wouldn't have said, "Yeah, I'd be watching, a television show or a 2-hour movie on my phone while I'm sitting on a subway train." So it's still early days in terms of the adoption of technology and how that's going to change things, and we just don't know. But we know it's going to evolve how businesses practice, and we clearly see that there's productivity gains. Oh, Ryan's on mute.
Bubble warning. Bubble. No bubble.
Bubble.
Early innings.
Early
Go Jays.
innings. Go Jays. Yes, Friday night. Um, okay, so what kind of signs should we look for to know we're in a bubble? I think if we start to see quite a bit of the data center build-outs being supported by debt, and we are starting to see a bit of that in the private debt markets financing some of the build-outs. If we see NVIDIA and some of these hyperscalers take on debt to finance these build-outs, that's a warning flag. The circular vendor financing, we're starting to see that. So, for example, NVIDIA is giving OpenAI $10 billion, and then OpenAI is turning around and buying NVIDIA's chips. So we're starting to see a bit of that. So that's a bit of a yellow flag, something to monitor. Overcapacity, not an issue right now. U.S. utilities need to build out something like 1.1 terawatts of power just to support the data center buildouts that have been identified already. I don't see the overcapacity being an issue at this point. Productivity gains, we are seeing that. It's not like we're building these data centers and there's nothing to show for it. And then the return on investment. So this is more of a question, I think, in a few years. What is the return on investing in all these data centers? I also kind of think back to, you think of like Amazon. The argument with Amazon always was that they never made any money. And they kept on spending a ton of money. And the bears would always say that stock just didn't make sense until it did. Uh, they gained so much market share that they now control a huge portion of the retail market, retail consumer market. And so we could see this kind of similar scenario where there is this tons of spending on building out artificial intelligence and hyperscalers spending on data centers, and investors aren't really concerned about the return because they know it's coming. But it's obviously something market is concerned about. So we need to know what the return on investment is, but we won't know those answers for a very long time. Warning signs for a bubble. If nobody was talking about a bubble, that would be concerning. The fact that, looking at AI or Google Trends, search trends for AI bubble have skyrocketed. Most times that we're in a bubble, we don't really know we're in a bubble. So the fact that majority of people are searching for this term suggests at least we're not at the peak of the bubble. And then remember the irrational exuberance I was talking about. This chart shows you consumer sentiment. I point out that consumer sentiment was near a high near the dot-com bubble. Today, sentiment is like, I don't know, it can't get much worse. I think, and maybe take this with a bit of a grain of salt. If you were to break out consumer sentiment based on Democrats and Republicans, you'll get two different measures. If you just polled Democrats, it would be 38, so kind of similar to where we are today. If you're to poll Republicans, you'd be at about 98, so up and around here. So maybe this chart is less useful given the politics in the United States these days and how polarized people are. But I do think it's interesting that sentiment is near rock bottom and not even really compared to the irrational exuberance of the dot-com bubble.
Bull market, is it intact, Jason? I think sometimes people think it's like a hockey stick. Rarely kind of is that case. So if you can provide some perspective on that, I think that'd be great.
Yeah. Yeah, so we've shown this this chart before multiple times. We're about 3 years into the bull market. If the bull market were to end today, it would be one of the shortest. That would be extremely surprising given what we're seeing in terms of artificial intelligence spending, interest rates moving in the right direction, fiscal stimulus coming in 2026, and earnings, really positive earnings growth for the S&P 500, and not really peak multiples. So I think more people lose money sitting on the sideline worrying about a bubble than actually the bubble bursting. This market could go on. I mean, I don't know how long it will go on, but it could go on for quite a while. And you really don't want to miss that upside in the market. Shown this chart in the past as well, just kind of illustrates what you can expect in terms of annual returns in the S&P 500, the US market, and drawdowns. So this year we've kind of had a typical year. We're at about 14% on the S&P 500, and we had a 19% drawdown. Your average drawdown, intra-year drawdown is 14%. So that's your typical year of volatility. We're pretty much in a normal year, which I think probably surprises a lot of people. Don't fight the Fed. That's a very common term I've heard over my career, over many years. Don't fight the Fed, which is basically a mantra that says if the Federal Reserve is providing liquidity to the market, don't fight it. It's very difficult to fight the wall of liquidity coming into the market. And now you have monetary stimulus moving in the right direction and fiscal stimulus moving in the right direction. Two very powerful influences on the broader market. Not only is the Fed cutting rates, but you have the Bank of England and the ECB cutting rates this year. So lots of stimulus. I would not expect, I mean, obviously you can have volatility in the market, but I expect the markets to continue to make new all-time highs. And then just on the fiscal stimulus we showed in a previous slide, about almost 1% of GDP has been added through fiscal stimulus in 2026. That's a powerful trend that should benefit consumers, industrials. It's a pretty risk-on environment heading into the midterm elections. All right, bottom line.
Fine.
Bottom line, portfolios are doing pretty well. Since we launched the pool, it's up 52% since inception without experiencing the same downside risk. You can see the TSX is making up a little bit of ground versus the pool this year. Why is that? Well, gold. Gold has been on a record run. The Canadian material sector is up somewhere between 70 and 80% this year alone. A lot of that being driven by gold. We do have an eco in the portfolio, but we don't nearly have as much weight in gold as the index, and hence why the index is catching up. But as you know, materials and commodities can be terribly volatile, so we are not placing all our chips in one place. We're diversified, and we're more concerned about protecting those downsides while trying to participate in the upside. So just to wrap things up, current valuations are elevated, but we're not in bubble territory compared to the dot-com bubble. The current market is supported by earnings growth, not only from the hyperscalers, but the market in general. We are starting to see productivity gains from the adoption of AI, which obviously that is positive for earnings as well. We have fiscal stimulus coming. Well, we've started to see interest rate cuts in the United States, as well as other central banks. Don't fight the Fed. It's very supportive for equities. Bull market appears intact. If it were to end, it would be one of the shortest bull markets in history. And, obviously there's concerns about the bubble, but, we're in the business of managing risk. You have to assume risk to make return. As we start to see more of these warning signs that we might be near the peak of the bubble, we will be adjusting the portfolio accordingly. Obviously, we have a discipline that we adhere to, which has proven well over the long term. And as we have more concerns that potentially the market's getting a little bit overheated, we'll start to make those adjustments within the portfolio to minimize those downside risks. And one last item, some housekeeping. We will be launching a fixed income pool in the new year. This follows the launching of our equity pool in 2023. And some of the benefits you will see from the income pool is it's kind of the same things that we have from the equity pool. We get better exchange rates when we're converting Canada to US. We'll get institutional pricing on the underlying funds that we use within the pool. We'll have increased income opportunities, and I think the biggest one for clients is one tax slip at the end of the year. So pay attention. We'll be sending some information out on that in the coming weeks, and we're excited to have two pools under our laps, under our umbrella, and stay tuned. And questions, if there are any.
None have come through yet, but I'm thinking of some kind of general ones that people like to ask. What are some of the measures in place to handle some of that volatility on the downside, Jason?
Yeah, well, it's obviously important. We have our investment process. Sticking to the process is important. And as we start to see signs that equity markets are potentially getting a little bit frothy, we will begin to A, raise a little bit of cash, B, move into more defensive sectors within the, for example, your consumer staples, your utilities, and healthcare. So that's the best way to protect capital in terms of within the equity sleeve, and then in terms of overall asset allocation, being prudent about when you have gains in equities, well, it's time to rebalance and move into fixed income. If you look at long-term returns, having that proper asset allocation and rebalancing accordingly is a big factor to generating those consistent long-term returns for clients.
Got it. Thanks. So we got another question here. What was the source of the consumer confidence data? Was that just the US or was that North America?
That was US. Yep.
Just the US.
US
Okay.
consumer. Yeah.
There's a
Not
follow-up question to that. Given the US BLS, the Bureau of Labor Statistics, is being choked, how reliable is that data coming out of the US now? I guess it's more of an opinion-based question.
Yeah, that survey was not BLS. So there's lots of private surveys. You can look at the ADP for employment. There's the JOLTS. JOLTS is BLS. How reliable is the data? Well, the data is not coming out, so we can't really look at it. But there's lots of other market indicators. For example, like our research providers are able to survey the companies that they cover to get a kind of real-time feel on, are they hiring, are they hiring, firing, or doing nothing. So we can kind of get that data. It's not official data, but we can get that data through our research providers and get a read on what the US economy is doing.
Got it. Question on the pool. What type of returns do we expect from the new fixed income pool?
So historically, I believe the annualized return on managed income is about 5.5%, 6%, around there. I would expect a very similar return, if not better. So I'll set expectations low, and we'll over deliver.
Got it. Popular one, I think we always get it. USD CAD. What do we think?
Similar story. I don't see much movement in the CAD. USD looks like it's basing here, at least the dollar index. Canadian dollar, it's about 71 cents versus USD. I could see it trading back into the 69s, but I don't see a lot of upside. If you look at CAD versus pound or euro, it's quite astonishing how weak the Canadian dollar is. It's really been masked by the weakness in USD. But versus other currencies, Canadian dollar has been whacked.
Got it. Okay. Interest rate forecast. You kind of went over it with that chart there, but maybe what you think for the balance of the year and possibly into next year.
Yeah, I still expect some more rate cuts from the Fed. Definitely think, looking at labor markets in the US, the Fed has definitely moved from their concern about inflation to growth. And so I think they're pretty much locked in to continuing to cut interest rates. That will, I think, only change once we get a few more inflation prints if the inflation surprises the upside. But I think the Fed will probably let inflation run a little bit hot here. So I would continue to expect a few more rate cuts. We don't want to see a lot of rate cuts, just a few. Because if there's a lot of rate cuts, that means the U.S. economy is weaker than we'd like. So we just want to see a few cuts. And in Canada expects rate cuts. There's kind of a limit of how far we can go unless we're in a complete crisis. So Canadian, I think we'll probably definitely see a cut this month, and then I think a couple more next year. But I'd kind of expect a floor on how far the Bank of Canada can take interest rates in Canada, unless we're in a full-blown crisis.
Got it. And that probably affect the dollar anyways, right?
That would affect the Canadian dollar, yeah.
Not much more coming through, but so I think we can end it here, Jason.
Great. Well, Thank you everybody for joining. Yeah, have a great day. And next time Seth will be back.
I think so. I hope so. I hope everyone enjoyed having me on as, I guess, kind of a guest speaker there. I guess there's one more question, Jason, since you're
Yeah.
a Toronto guy. What's your call on the World Series?
Ooh. Uh, Toronto in six.
In six?
In
Okay,
six.
got it. Okay. I mean, I don't know. I'm a Shohei fan, but of course, I'm rooting for the Jays being the only Canadian team. But
It's pretty
okay,
exciting. It's been
yeah,
32 years. I was downtown when they won, which was pretty cool. And I walked all the way home from downtown up into Leaside, which took me 3 hours. I got home at like four o'clock in the morning because the streets were just jammed. You couldn't.
yeah.
Yeah,
Good reason to get down there.
yeah.
All right.
Okay. Thank you everybody for joining. Hope you have a great day, and we'll talk to you soon.
Thanks. Bye.